Well, after a plethora of different central bank speakers, we see a more data-dependent scenario. As a result, we see financial markets trading in a range, and we'd be discussing all the levels that you need to look out for there. We see the dollar holding the keys to the financial markets. Now, my heart and my body tells me to sell risk, but my mind tells me no. We go into all these factors in the trade-off. Well, hi traders, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we're going to be going through the setups, the front of mind, the key thematics that are driving markets. And this week, the central focus is on this kind of range environment we've been seeing, this scatty price action that we're starting to see creeping up, with a big focus on what is going to be the Mac Daddy of catalyst next week, the US CPI print. So let's bring in the great man, Mr. Blake Morrow. How are you doing, my American friend?
Was that an R. Kelly reference from your
It was,
intro?
mate, it was, which is controversial, and I apologise for that, but it just felt right at the time. So anyway, we'll move on quite swiftly from that one. Blake, I'm going to change tacks because I'm not a controversial character. But it felt right? And we're looking at a situation now where, yeah, we've had all these different central bankers, and we'll go into the topical funder section in a second. But yeah, I think, are we desensitized to that situation now? We know they're in this kind of data-dependent mode. Yeah, are you sick and tired of hearing their rhetoric? Do markets really care anymore?
I don't know. What's your body telling you to do, Chris?
Okay, he's not letting it go, is he?
Sorry.
He's rinsing it. So how are you feeling about central bankers, Blake?
You know, I'm feeling that I've heard enough. I really have. And I think the market has as well. And you can tell, I think the market's like kind of poised and ready to go. I think things have kind of reverted to the mean somewhat, and I think we're like preparing for the data that's coming our way now. I think we've heard all that we needed to hear from central banks, and I think the market's kind of, I want to say stunned, but I think repositioned or at least neutral a little bit. How about you?
Yeah, I think that's right. I mean, we're in this data-dependent mode, and I want to talk about this situation with you in topical funders. So let's bring it in right now. Yeah, Blake, I want to talk about sentiment. We always bring this one up, or we often bring this one up around. I mean, I think what we've seen is this situation now where the ECB, the Bank of England, have moved to a sort of more data-dependent mode. We've heard, left, right and centre from Powell, Kashgari and all these different, John Williams and the Fed officials. But really, the market's sort of making up their own mind that central banks are now being dictated to by the data. And so as a result, we're kind of seeing this kind of choppy price action in the dollar. We're seeing the NASDAQ and had a big fall last night. Certainly Alphabet's a big one there. It seems that their BARD product, the AI situation is disappointed. What an awful name. What an awful name. They got 150,000 employees over at Alphabet, and they come up with a name like BARD. I mean, come on anyway. But yeah, the stock was down about 8%. But we've got these kind of holding patterns coming through. It's really the CPI number that people are driving. People don't want to put on too much risk ahead of that situation. So yeah, how are you reading sentiment? We've got the VIX sub 20%. You've got that sort of range trade that seems to be taking place in the S&P, 4,200 down into 4,100 at the moment, just below there. Seems to have established a bit of a range. You've got the dollar into 103.50, but it just really doesn't want to break through that. Gold trading sideways. How are you seeing it now? Are you seeing the skew in risk to the downside, or are you seeing it to the upside right now?
Well, I think the skew is to the downside. I do think it is, because I mean, I know we're going to talk about data here in a moment. And
so your body's telling you risk goes lower, right? Your heart's telling you.
But my mind is telling me otherwise. The thing is I believe that asset managers want to be bullish. I think technicians that have been short have like reevaluated their positions at this point, and I think people just want to be long. But they need the green light, but I think people are not willing or not afraid to pull the plug at this stage. So we are in this standstill, and we are going to be in this standstill probably ahead of next Tuesday's data. But
I'm going to take a different side of that, mate, because I think asset managers want to be short risk right now. The fair value on the S&Ps, if you're looking at a liquidity framework, or if you're even looking at the equity risk premium in the S&P, for example, it's the lowest equity risk premium we've had since 2007. I think they want to de-risk, to be honest. I think they actually want to de-risk, but The problem is the market keeps going up. I know we talk about this range at the moment. The market kept going up on junk. It was bad quality. It was short interest stocks that really dominated and pushed this up. And so, but they had to be involved. This fear of meaningfully underperforming FUMU, they had to be going in, and they didn't want to do it. I think they want the market to come back down to a more fair value level rather than chase where they are at the moment. How do you feel about that?
Well, I get exactly what you're saying, but you spelled it out correctly. FOMO. People have to be involved. You have to be involved. FOMO. Anyway, they have to be involved, and I think people are willing. Asset managers are willing to chase the market higher if they have to.
Well, you've got JP Morgan, Goldman Sachs, Morgan Stanley, Mike Wilson, all coming out of notes over the last 7 days, all saying that the market's going to revisit recent lows. The skew of risk is the downside. We as traders, all that matters, Blake, is price. We're a slave to price. You can come out with these theses, but we're a slave to price, and at the moment, we'll react when price deteriorates and volatility picks up a little bit more there.
Well, volatility is going to pick up with our next topic, which we're going to talk about the CPI. So, Chris, what do you think? Is it going to be hot or not? I mean, the U.S. and the rest of the world is greatly and highly anticipating next week's numbers.
Absolutely.
They are. I mean, this is like, I believe
nothing else matters. Nothing else matters.
Nothing else matters. Puts us in this Mexican standoff, where, you got all the gunslingers. They're going right. Everybody's pointing a gun at each other, shorts and longs, trying to figure out, are we going to press it or are we not? And everybody expects that inflation is going to continue to come down. But you look around and you look at like what we just saw in employment with non-farm payroll. I'm not so sure that that inflation is going to come down. What's your take on CPI?
Well, let me ask you a question, and we always do this, right? So if you look at where the market's kind of positioned at the moment, headlines expected to drop from 6.5% to 6.2%, so dropping 30 basis points. The core number, which is probably the more important one, is expected to drop from 5.7 to 5.5%. So I ask you now, where is the pain trade? Where do you get the bigger move if we were to see in risk? So if we were to see below expectations, are you going to see a bigger rally than we would see de-risking on an upside surprise? Where's the pain trade there?
I still think the pain trade's higher.
Yeah.
And I know you're going to disagree with me, but I think the pain trade's higher, Chris.
No, but what I mean is that do we see a bigger move in markets? That de-risking, if we would see an upside surprise. So you think that if we get a below consensus print on core, that there's going to be a bigger upside move in equities, the dollar's going to come off than if we were to see an above consensus move there?
I think so. And I think what's going to happen is you're going to have people buying right into that weakness. If we see stocks de-risk, you're going to see people step right into it. Yeah. And I think any rally is going to be thwarted with the dollar. So that's how I feel right now, at least based on where the market's at, where the market's currently at technically too. And we're going to talk about the technicals here in a bit, but I get what you're asking. And I still think the pain trade for the market is higher. Yeah. As you say, people want to de-risk. People want. I don't know if
I don't disagree with you. That the thesis here is that the market is firmly of the belief that inflation's coming down. It might not get to target this year. It might be something that comes out next year. And so that you've got this idea that if we were to see core inflation below 5.5%, 5.4 below, then that thesis is validated and it gives green lights for investment managers to put more risk on and position gets more long. And that's where you're going with this. And I agree with that. Yeah. The concern I've got is if that narrative and that consensus view is challenged, and therefore that would be a higher CPI number, and then that view, when consensus is challenged, that's when you get volatility. So I think, where is that consensus challenge? Well, if you got a core number above 5.7% or above, then that consensus view is challenged. I think the dollar goes on a rip-roaring rally. We're going to see real rates moving up, and that would probably therefore open up the debate that do we get a 50 basis point hike at the next Fed meeting? So that's where it is. So a low inflation number validates the stance of the current pricing. Everything's happy. We can live a happy life. But it's where that consensus is challenged where I think you could get major volatility.
And that's why I really, really, and I know we need to move along, but that's why I really, really hope we get a number that is in line with expectations, or even slightly higher, because I want us to have an opportunity to sell dollars higher. I want an opportunity to buy stocks a little bit.
Well, let's go into the rates pricing, Blake. So, it sort of feeds quite nicely into that. So if I go into Fed funds futures or swaps pricing at the moment, the next Fed meeting is on the 22nd of March. Okay, so what we're looking at is a situation we've got 26 basis points of hikes being priced in for that meeting. The market's saying right now a 25 basis point hike is a done deal there. So what kind of inflation number brings a 50 basis point hike into the scenario, which of course, if that was the situation, then obviously dollar yen's going to rally significantly. You're going to get gold prices lower. You're going to get the NASDAQ under a bit of pressure. It doesn't take Alphabet coming out with poor issues going with their AI system to do that. But, we have seen some good leadership in tech. That's obviously come undone a little bit there. So we know there's volatility. But what is the sort of numbers we're looking at? I don't think we're ever going to get a situation where a full 50 basis points is going to be priced in just because of this CPI print. But you could see a situation where that 26 basis points goes to, say, 35 basis points. So it opens the door to a 50 basis point hike. So that's the issue. So we've got 26 priced in. We've got terminal pricing at about 5.15 at the moment. That's the highest point. How do you see those rates pricing being affected by the CPI print, which is obviously going to have a big flow-on effect to sort of more generic asset classes that retail traders look at?
Well, I think a lot of the repricing happened after non-farm payroll, right? So, anybody who was expecting, a bigger rate, rate hikes to just kind of be steady after quarter point hike, that was kind of thwarted after this Friday, this last super strong jobs report. Now, I think we're going to have to see inflation really come in kind of near last month's prints in order to raise those expectations again. Is that what you're asking me?
Yeah, no, I think you're right. Yeah, you bang on there. I mean, I was going to say, if we were to see a core CPI number at 5.8%, which is actually a little bit of a tick higher, that would be a shock to the Fed. And they would go, hang on a sec, it was supposed to come down. We've seen 3 months in a row now with lower inflation prints. This was not supposed to happen. Obviously, we're looking at the elements of the basket that have made that. But I think, if we were to see 5.8%, which is a tick up from last month, then that would be a big shock. And then, this 26 basis points would probably go to around 30, 35. And it would be open. Yeah. And then obviously we can have another payrolls number before that point as well, which, again, if that was super, super, super hot, it seems like everyone in America is getting 2 jobs at the moment. I think you're the only one who doesn't have 5 jobs based on that last non-farm poll print.
Maybe you haven't worked behind the scenes at Forex Analytics. I kind of actually have a few jobs.
But look, I mean, I think that's it. I mean, I think there's the chance of a 50 basis point hike in March is very, very high. The bar to get there is high, but it doesn't mean the market's not going to price an element of that being a risk. So I think, 5.8 would be my threshold to see that about 35 basis points being priced in. Conversely, if we were to see it, say, 5.3, 5.2, which would be a big, big surprise, do we see people saying, well, that terminal pricing is just far too high at 5.15. So, I think this CPI number is going to be a big deal. And the volatility, the implied volatility across asset class for that meeting, for that event, for that specific day is very, very high. So the market is expecting fireworks on CPI there. So it's an interesting one.
All right. Well, that is going to, it's going to be a huge one. And what's going to be most affected in the markets, in my view, is going to be our next topic, is going to be the dollar, because the dollar, in my opinion, is very much at a do or die level. Technically, we're going to talk about it here in a few moments. We're going to talk about, what the dollar actually looks like to me from a technical viewpoint. But, so many people are so quick to call the death of the dollar this year. They think that the dollar is going a lot lower. I've heard some analysts talking about 130 euro this year. I know it's crazy, but that's what I've heard. And so, this is really like the do or die level for the dollar and the dollar index, as it is. I mean, if you believe that inflation is going to continue to come down, and you think that we are stepping into a global recession, even though that, the U.S. continues to create, a lot more jobs than expectations, and the economy seems somewhat, sustaining right now. Are you going to be are you going to be wrong here if the dollar breaks out to the upside, or is this like a perfect healthy pullback to, get the euro back below parity and the dollar index, higher again to maybe even challenge what we saw last year? What are your thoughts about where the dollar's at? Because I think it's a big, huge debate right now, and it is going to be influenced by next week's number, of course.
Yeah, it will.
But I think the dollar is at a do or die spot.
Well, the reasons for the euro rally have been touted millions of times. There's no point in revisiting a lot of those situations. But I think for the dollar to rally another 5-10% from here, we are going to need to see the US exceptionalism story regroup again. I find that hard to believe that that's going to be the case. So we'd need global growth to really come under pressure again and roll over. We'd probably need to see the Chinese reopening story become a little bit more problematic, and a few concerns around how that's all looking. But yeah, for the dollar to get a one-way, and I'm talking about a trending environment for traders to trade, we need to see the dollar exceptional story ramp up. And I think you'd probably need to see equity markets really head lower, and using the dollar there with its negative correlation to become the asset class of choice to hedge out that exposure. And I don't see any of those situations happening. So while I do see upside, I can make a case for upside risks in the dollar. Certainly if CPI comes out hotter, I'm hesitant to believe we're going to see a new bull trend in the US dollar, maybe on selective currencies. But I think we need to see, the checklist isn't there for me at the moment. What are you thinking?
I had I interviewed somebody who his name's Ken Morrison on the markets. He's a longtime commodities trader since the 70s, and I have so much respect for him. And he brought a really great chart called the BDI, the Baltic Dry Index. Yeah. Take a look at that chart. Pull it up when you get an opportunity. Pull it up, and that might tell you a little bit different story about the way the market views the China reopening story. And I think it's a really fascinating chart that does, kind of tell a story there, which would be very supportive of the dollar, by the way.
Well, I've looked at the Baltic Dry, and I know there's probably viewers out there who look at it quite religiously, but I think it's given us so many false signals over the years that it's a tough one. But I haven't listened to your interview, so I'll be interested to hear what Mr. Morrison has to say. But let's go into some of these charts. I'm really, really keen to see your one on the dollar there. So let's bring up, that's a setup. I want to bring up the US 500 or the S&P. I could have brought the NASDAQ up because that's generally we're seeing the bulk of our flow at the moment. Everyone loves a market that's moving. The high beta plays are always going to attract the day traders and the short-term traders. But yeah, look, obviously we've got the US 500 here. You saw a break of the downtrend. You're actually seeing price trending higher at the moment. But we do seem to have come into a bit of resistance in around 41.80. And as you can see, last 5 days or so, the bulls have really struggled to push this one above that 41.80 level. I thought, if we could get a move there, then it opens up, a nice move up into 4,300, which is that black horizontal resistance level that you can see up there. And I thought that would have been the place we'd look for better shorting opportunities. But we're in this kind of holding pattern at this point, and it's kind of dictating a lot of flows. If we were to see that break out, I think you're probably going to see the dollar under a bit of pressure. If we see it roll over and head back to trend, form a trend support, the dollar's probably going to rally. But a lot of that move that we've seen throughout this year has been on very, very low quality junk stocks. It's been very short interest driven markets. Tech had a good gain yesterday, but generally speaking, it's been very low quality on the way up there. So we're in this holding pattern, and this is a setup, isn't it? So you want to trade the break. Which way does it go, Blake?
Well, it's a great question, because last week we closed with a false breakout above that the old horizontal resistance that was like the December highs. But here we are today, yesterday we were perched just above that. But one thing about price here is, Chris, and we as traders we're slaves to price.
Slave to price.
The pullbacks have been very minor, and they're very shallow. And I always have that saying in the back of my mind. The markets can stay irrational longer than you can stay solvent. So, the markets continue.
You didn't coin that phrase, by the way. That was
of course I did not. No,
Mr.
we've
B.
all heard that before. that we have not. That's
Blake's
an old
coming out of it, plagiarism here. I like it.
No. Like I said, you've heard it before, but not from me. Well, you've heard it from me. But anyway, the markets are well bid here, and I think that while we're above like 4,100. We still got to continue to look higher towards 4,300, I think. Even though it's junk, Chris.
It is junk, but yeah, I mean, I'm waiting for the moving average crossover just to get out of the trade. But yeah, I mean, look, when this range breaks, I'll be respecting it. For now, I think this is one where you can take it into a much lower time frame. And market environment is so key for day traders and short-term traders that, if we're in this kind of sideways choppy trading pattern, you can take it into much lower time frames and trade mean reversion within that. So you can bring up a VWAP or something like that and trade mean reversion within this range that we seem to have established until it breaks out. That's the way I'll be looking at that.
All right. Well, I'm gonna pull up the chart on gold. That's actually my next setup because this is what we call a bear flag pattern. We had a throw over as we were approaching the 2000 mark. We couldn't get above it. We were trading well above that channel. You can see that highlighted area, and we got a throw over. So we dipped back into the channel, and now we have this bearish consolidation. I want you to take a really good look at those candles of the last 3 days on gold spot. Those are pin bars, and pin bars show lack of enthusiasm to the upside. So they're developing what we call a bear flag pattern. And a breakdown would take us below that channel, and that's what usually false breakouts or throwover patterns do. It'll lead us down to the 50% retracement. Previous highs back in November, the 15th of November, would take us back around 1790. And I think gold's kind of waving the white flag here, like I give up. What are your thoughts here on gold?
It's a setup. It's what you do, Blake. You bring out the charts time and time again, and this is a great one. I mean, this is music to a lot of people's ears at the moment. I mean, certainly the skew of our clients is short gold at the moment, only just, but it's they are expecting a bit of downside. But yeah, again, this comes down to what happens in the dollar. You've got 5-year real rates, which are 5-year treasuries adjusted for 5-year inflation expectations. Effectively, the real returns there, they're trading at 1.32%, 132. We're sort of stuck in this range of 150, 111. So if real rates were to move up and the dollar was to rally, then you've got your target, and that setup breaks the downside, in my opinion. And that's what it's going to be looking at. But yeah, for people out there those people out there who are not looking, at these cross asset influences, just look at price. I mean, just keep it simple. And when it breaks to that, these bear flag patterns, especially when you see such a pronounced sell-off coming through, consolidation, when they break to the downside, they can be very powerful indeed. So I love this setup, and this is what we call a high conviction setup. But you've got to wait for the market to reveal itself. Wait for that upper trend to break. I'll go along for that. I'll be shorting gold, but wait to the market to push you into that situation. And talking about waiting for a market to push you into a situation, let's have a bring up Ethereum, because look, we're knocking on that ceiling, bang, 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 time and time again. I know there's a kind of a rule in breakouts that it has to happen after 3 different attempts, but we've seen so many different attempts to try and break through this horizontal resistance levels that you've seen there, and it just feels like it wants to do it. The question you've got obviously is trading breakouts. So many of them fail, but when they do get it, you've got to stay in the position, which is kind of why I like to use mechanical stops. 3-day crossing over the 8-day, or waiting for price to close back below on a daily basis below the 5-day exponential moving average. But when this goes, it could be very powerful. You can see those Bollinger Bands are contracting. That volatility is narrowing. But again, this is not, if you buy now, it's very, very aggressive indeed, because, this will get affected by the dollar and CPI next week. But when the market reveals itself, then I'm in. And so whilst, we can take a negative view on gold if that breaks, for me, if this does break and close, it could be a very powerful force for Ethereum. What do you think?
Oh, well, I think we talked about this last week, and I believe it's, like most of these other markets, Chris, it's just consolidating, but it's consolidating gains. And it's not pulling back. So that means it's not getting shorts an opportunity to exit. It's not giving longs an opportunity to buy. It's just holding up here. So I'm with you. I couldn't agree with you more as far as you got, once you get the breakout, you got to let the breakout take hold, and you got to, try to trade it mechanically and just kind of move your stops along the way. But it's holding up, and like any setup, Chris, you're kind of waiting for the whites of their eyes. When you see the whites of their eyes, that's when you shoot. That's plagiarism right there that Blake's doing, and I've done it now twice today. So
3 strikes, Brady. 3 strikes. I just want to touch this because
you want to call me.
I'm going to overrun, and I can hear my producer screaming in my ear. But I think that the idea,
especially.
the mechanical stop thing, I think, is really important. When you get a breakout and it goes, the emotion to take profits too early is just so important. You've got to get as much juice out of that trade, and that's why I love using moving averages. Fine, they're a lagging indicator, and don't chastise them. Price is price. But just using a moving average system, or using an ATR trailing stop, keeps you in the trade when the emotion and your body is telling you to get out of the trade. So I really like that idea. When breakouts go, they can fail so often, which is why this idea of winning every time is wrong in trading. You're going to be wrong a lot, especially in breakout trading. You've got to accept that. But when it goes, you've just got to capture the move. And if it really goes, you've got to be in it to win it. And that's why I like these mechanical stops, because they keep you in the trade without and remove all the emotion that comes with saying that you've got to be right. Anyway, I'm getting wrapped on the knuckle here, so let's move on.
Let's take a look at the dollar index, because I mentioned, Chris, with the dollar, I have breakout points, and I think they're very clear in the dollar. So, and obviously we're going to be looking to see if we get a move ahead of CPI, which is possible, especially when you're in such a tight range. But take a look at that channel. That channel has really been in existence since November. We're challenging the upper end of it, and that comes in at 104 on the dollar index. 103.80, really. It's like 103.85. If we break above 104, though, that's a bullish breakout, and you've got to respect it, especially if you've been a dollar bear. The flip side to that is the 103 level back to the downside. That's where you have to just assume the dollar is going to resume its downtrend. We're dipping back below a big broken trend line, which is that big, or it's the ascending black trend line that you see through there. That's at 103. So below 103, you have to be bearish. Above 103.85, 104, you're bullish. Those are my breakout points. What are your thoughts here on the dollar index?
Yeah, I like it. I like having that definition, and using the momentum to guide a bias. I think it's a really good one. It does feel like this looks almost like it's being driven by dollar yen. That's a very similar setup to dollar yen that recently broke out of this channel. And obviously we've got our all eyes on the Japanese yen, because this tomorrow, and we're saying this on Thursday Australian time at the moment, but tomorrow we're expecting a new governor to be announced. Amamiya. I think we could all come out with different saying to that. So Amamiya is supposed to get the gig, and some people are saying, if that's confirmed, then we could see the yen weaken. Look, this looks like it's a very similar setup to dollar yen. And that's one to keep on the radar. But I love the idea of using levels when it breaks to show just there's a momentum and a trend growing. And I think that you bring up some good points there. So one to keep on the radar. But the dollar for me is so important for if you're using a liquidity framework and you're using balance sheet frameworks or anything that's a bit more sophisticated. The dollar has really big implications for that liquidity element there. So the dollar, for me, is central to everything that's going on, along with rates. Anyway, so let's go to play of the day. Let's see what's front and centre on our minds today. Yeah, I brought up sterling CAD. I really like this one because my man Michael Brown at Trader X really wants to go and see Celine Dion in concert later this year. And so obviously his sterling is going to get a bit weaker if my trade idea comes out. So what I've got on the left, it's not a particularly pretty way of imposing this, but I've looked at the rates pricing in Canada, right? So you've got the next meeting on March the 8th is 1 basis point. Basically the market's saying that the Bank of Canada are done. The market are pricing pretty much a done deal for the pound, maybe one more rate hike in the meeting ahead. But I think that could be misplaced. Now, the Bank of Canada have made it pretty clear that they're waiting for economics to really feed up or rates to play through, and they're on a pause. But that may change. We've got an employment number this week. We're expecting some good numbers there. And then we get another CPI number coming out before that meeting. And trim mean or core inflation in Canada has been about 5.3% for a number of months now. If that comes in hot, then I think that market could revisit this pricing situation. And because they've been on pause, I think the markets could say they could actually start their rate hiking cycle. So I'm looking at the Canadian dollar here and the idea of, is the market correct with their pause? That CPI number is going to challenge that. You can also see sterling CAD at that support level. If it breaks through there, I think that could be a really interesting cross to look at there. So I'm waiting for the break there. There's some natural catalysts for the Canadian dollar. I know there's a lot of people out there who probably disagree with the Canadian call because they are on pause. But I think that if the market challenges that view for a new rate hiking cycle and it breaks through there, you've got a fundamental and technical view which takes the sterling down against the Canadian dollar.
Well, I like it, Chris. And my play of the day is going to be the Nikkei. And this is a CFD. I don't trade the Nikkei all that often, but I think it's a great play because if the market truly is going to be leaning lower and you start to see stocks move lower and risk move lower in general, I think the Nikkei is very well defined. It's rolling over from a 78% retracement, a descending trend line that's really been in place since August of last year. And I think the risk is well defined. And as traders, despite what your beliefs are, whether you believe the market's continuing to go higher here or it's going to move lower from here, the thing that we can control as traders is our risk. So I know where I'm wrong. You're wrong really above that 78% retracement, above like 27,900, right around there. That's where you're wrong. But also, you see that 200-day moving average, that comes in right around 27,200. And there's a horizontal support at 27,150, right around there. We break through that 200-day moving average and that horizontal support, it should accelerate lower. I think the setup's there. And if you're a bear, this might be one of those indexes you keep an eye on.
Yeah, so if we're looking at that if this our view to short risk comes out, maybe the Nikkei is one to look at. I mean, for me, I've been pushing this kind of long Nasdaq, short US 30 trade. I've closed that one now. It's been a good performer, but I'm concerned around tech into CPI, so I'm closing that. But if we do think that the risk is going to roll over, and we're looking at an equity index, for example, as a vehicle to express that, then the Nikkei is looking at the moment more of the vulnerable ones for you there.
Yes, it sure is. I agree.
Yeah, cool. So we see that happens there. We'd like a bit of volatility to pick up and, obviously a bit of hedging flow to push markets a little bit lower. So we'll see that. Anyway, we've talked a lot about what's going on in the world today. It's obviously all eyes on CPI next week. Love to get some of your likes. Love to see some of your comments around what you think is the balance of risks around some of the factors we've been talking about today. Anyway, we'll see you next week for more of the trade-off.